Today, almost everything you see around you runs on debt. Countries, corporations, banks, even ordinary people. But according to Robert Kiyosaki, debt is not just a problem, it's a weapon. He says, the rich use debt to get richer, while the poor use debt just to survive. But behind that famous quote lies something deeper, something darker. A system that does not work the way people think it does. And what if everything we've been told is only the visible tip of a very large iceberg? What if debt is not simply a financial tool, but a global mechanism of control? Welcome to Financial Chronicle, where we uncover the mathematics behind power. Today, almost everything you see around you runs on debt. Countries, corporations, banks, even ordinary people. In the early 2000s, one idea dominated American culture. Home prices always go up. Buying a house wasn't just a financial decision. It became a national obsession. Families stretched their budgets, took on bigger mortgages, and believed the rising market would protect them. Banks encouraged this behavior. Every approved loan pushed home prices even higher, and every increase in prices justified even more loans. What no one realized was that the entire system was slowly spinning out of control. Banks discovered a new type of financial alchemy. They took thousands of mortgage loans, bundled them together, and sold them to investors as safe products. These were called mortgage-backed securities, MBS. On the surface, everything looked brilliant. Steady returns, low risk, and endless demand. But beneath the glossy labels was a growing rot. The loans were getting weaker, the borrowers less qualified, and the risk more hidden. Wall Street didn't care. As long as someone bought the product, the machine kept running. By 2004, lending standards collapsed completely. People with unstable incomes, bad credit, and no documented earnings were approved instantly. These borrowers were known as subprime. Lenders pushed them into risky mortgages with low introductory payments that would later explode. They knew many of these borrowers could never repay, but it didn't matter. The moment the loan was signed, they sold it to Wall Street, and the risk became someone else's problem. Rating agencies stamped these toxic packages with AAA ratings, the highest safety grade. The world bought them with confidence, never realizing they were holding financial dynamite. For years, the Federal Reserve kept rates artificially low. Cheap money flooded the system, pushing home prices to impossible levels. But in 2006, everything changed. The Fed began raising interest rates to fight inflation. Suddenly, mortgage payments surged. Families struggled to keep up, and the first cracks in the system appeared. Homes stopped selling. Foreclosures quietly began, and the housing dream started to turn into a nightmare. The entire financial system was built on one belief: housing prices never fall. But when prices finally dipped, the consequences were catastrophic. As home values dropped, mortgage-backed securities lost value, banks couldn't hide their losses, and investors panicked. Fear spread faster than any virus. Confidence evaporated, and in finance, when confidence dies, the system stops functioning. In early 2008, Bear Stearns, one of Wall Street's oldest and most respected institutions, began to unravel. Its mortgage investments were collapsing. Rumors spread. Clients withdrew billions. Within days, the bank was insolvent. The Federal Reserve stepped in with an emergency rescue. It was the first sign that the crisis was far larger than anyone wanted to admit. But the real collapse was still ahead. September 15, 2008. Lehman Brothers, a 150-year-old giant, filed for bankruptcy. It was the largest corporate failure in American history, and the moment it happened, global markets froze. Banks refused to lend to each other. Stock markets crashed. Trillions of dollars vanished in hours. It was the day modern finance came to a halt. While the world focused on Lehman, another disaster was unfolding behind the scenes. AIG, the largest insurer on the planet, had secretly sold massive amounts of credit default swaps. These contracts required AIG to pay if mortgage securities failed, and after Lehman collapsed, they all failed at once. AIG owed hundreds of billions. If it collapsed, the entire global system would follow. The U.S. government had no choice. AIG was bailed out immediately. The crisis was no longer about banks. It was about saving the world economy. The crisis quickly jumped across the Atlantic. European banks had heavily invested in American mortgage securities. When the U.S. housing market collapsed, so did the balance sheets of Europe's largest institutions. Iceland's entire banking system failed. Britain faced emergency nationalizations. Germany and France rushed to rescue their own banks. This was no longer an American crisis. It was global. Between 2008 and 2010, the world entered the deepest economic downturn since the Great Depression. 8 million Americans lost their jobs. Millions lost their homes. Entire neighborhoods were abandoned. Factories closed. Businesses vanished. Retirement savings evaporated. This was not just a financial event. It was a human tragedy on a massive scale. To save the economy, the Federal Reserve slashed interest rates to nearly zero. Money became cheap again. Banks were flooded with liquidity. Governments borrowed trillions to stabilize markets. This created a new era, an economy dependent on low interest rates, massive debt, and endless stimulus. The world we live in today, from soaring asset prices to huge national debts, was built on the response to the 2008 crisis.